Whoa. Well, it looks like it's working. All right. What is up, guys? Welcome back to the stream. It's been a while. I haven't streamed in a while. And yeah, today I was building an income statement forecast, and I wanted to put this on live stream. Well, I'm already done, but I wanted to just put this on live stream. So yeah, we're gonna do this today. Let me go ahead and minimize my screen so you guys can see what we are working with. All right. I'm gonna put myself maybe over here. All right, over here. All right, cool. All right, so this is our template that we're going to be using for this video. And this is obviously going to be based on assumptions because we don't have historical data. But before we get into all of that, we're going to go do a nice little Google search here. Let's go to our, so for those that are not familiar with, income statements and forecasting, things like that, they're called pro forma financial statements, which essentially means that you are projecting something, right? In my videos, I talk a lot about, building projection models for a lot of things. And the income statement is one of the most popular financial statements that is projected, right? You're trying to know if your business is going to make money based on these projections. Maybe sometimes you haven't even started your business, right? And you are estimating certain things. We call those assumptions. And based on those assumptions, you want to know if you're going to be able to make money. Sometimes you project over the year, sometimes a couple years, sometimes 5 years. For this video, we're going to be doing it over 5 years. So small businesses really do this a lot. I was working on a project for a small business that was trying to project some of their financials, the income statement. Yeah, so check out this website if you want to learn more about this. It has, some of the things that are required in an income statement that you are projecting or forecasting, such as we can look at the historical data. If it's a company that's been around for a while, maybe for a couple years, you can use that data to it's more accurate. Actually, you're going to be using that data in order to come up with assumptions or in order to project what it's going to be. But sometimes if it's a new company that has never been in business or it doesn't have a lot of data, you're going to have to come up with assumptions. Then they gotta be reasonable. Obviously, you can't just like make up crazy numbers. You have to be realistic and they have to be reasonable. We talk about revenue here, go to cost of goods sold. We go into operating expenses and a bunch of stuff like that. So you can also forecast things like the balance sheet, the statement of cash flow. There's a lot of financial statements that you can project, right? But in this video, we're gonna be doing the income statement. All right. So I want to show you how every income statement is different, right? They're not always going to be the same, right? A lot of people will use, there's going to be a lot of templates when it comes to income statements. It's going to depend on what the company does. Sometimes you have companies that offer a subscription service, right? So their revenue source is different from a company that sells an actual product, right? If you're talking about maybe a company like a grocery store where you have to go in there, so they have to purchase the actual goods, and you can compare that to a subscription service company that does not have to have physical products, right, in the inventory. So let's look at my favorite company here, Robinhood. Okay, I'm on Yahoo Finance. I'm gonna look at so if you ever want to look at income statements and financials, go on Yahoo Finance and look for the company here. It's gonna bring up the kind of like the summary or overview of the company itself. But you're gonna go to financials here, and as you can see here, we have a snapshot of all the financials. You're not gonna be able to download this in Excel if you don't have a subscription. I do not, so I'm not gonna be able to do that. I just wanted to show you how every income statement looks. So, all right, now we can look at if you go up here on the menu, it says show income statement. You have the balance sheet. You also have the cash flow. So these are financial statements that you can project. You can forecast these financial statements. So we're gonna be looking at the income statement. So it's a basic structure. On the top, you have, the revenue itself, like the total revenue. You can see here, this is an annual, I think this is on an annual schedule. Yeah. So 2019, 2020, 2021, you see that, they were increasing their total revenue. You can click this drop down. Sometimes it breaks it down by the source of revenue. And next, you have the cost of revenue, which is essentially, how much it costs for them. Essentially, the cost of goods. That's what it is. So you have that on there. You also have the gross profit, and it's just like a simple template, but things are gonna be different, right? If it's a private company, you're not gonna have things like, let's see here, where's it at? You're not gonna have diluted shares and net income common stock holders. You're not gonna have that in a private company, and yeah, so I just wanted to show you that this is where you can find, templates. If you're working on, maybe it's a school project on build an income statement for this company, you can find a company that sells the same product or it's the same service, and you can copy the format of this. So I'm gonna be building a pretty simple income statement that you can use, kind of like universal, that you can use for anything, not just specific companies or all right, so now we are gonna go to the Excel file here. Let's see if you guys can see this. All right, so when you're building this and you don't have historical information that you can, for example, if you're gonna be looking at revenues, if the company was existing for the past 5 years, you can use that data in order to come up with the projected revenue. But we don't have that. This is a brand new company. So what I'm going to do here is, these are our assumptions here, our assumptions page. And we're going to assume that this is a coffee company. So we sell coffee online. We have our store in Shopify. And what we do is, you go on the website, you can purchase a bag of coffee, or you can subscribe to, let's say you can subscribe to the website where you can get a monthly bag of coffee, something like that. Okay, so we have the product and we also have kind of like a subscription service at the same time. So that's the business we're going to be going for. So my projections here, we have, first off, it's going to be the revenue, and we have the cost of goods sold, and we have the operating expenses, and we also have the tax rate. This is kind of like tricky, but I'm just going to be using an average for small businesses for this one. So for new customers here, so we're going to be projecting how many customers are we going to have let me actually add the years here actually. So I'm going to do year one. We can do so we can do I think this is 5 years actually. 3. Oh yeah, there's 5. All right, so actually there's no script to this, so I'm gonna be building as we go. All right, so let me go ahead and make this bold. All right, cool. All right, so in year one, we're expecting to make well, how many customers am I targeting to have, right? So if we're being realistic, a lot of people drink coffee. So I'm gonna say, I'm aiming to have let's say 100 customers. Do 100 here, okay? In a year, I think that could be done. Let's do 200. Let's do 120. We don't want to be too realistic here. I want to make this a little fun. So let's do 250. Start off with 250. And then the second year, we're gonna let's do also let's bring it up to 400. Right? This is not gonna be in any type of sequence. This is just let's just do let's say we have a actually let's make it nice and smooth. Let's do 300 here. And do actually let's be a little realistic. All right, so do 100, and then we're gonna do 200, and then we could do we'll do this trying to think of a good way to do this. Let's do 200, 200. No, let's just go like this: 300, 400, 500. Actually, let's do 1,000. I think this will make it a lot more interesting rather than just than like really. It sucks to work with like small numbers, so we're gonna make it a little unrealistic. All right, cool. So now we have our customers, right? So this is in numbers, obviously, because we're aiming to get 1,000 customers in the first year. Now moving on to the average order value. So since we have it is a coffee business, right? It's kind of, sometimes you have different tiers of maybe you purchase the lower quality, or maybe you purchase more. So we need to come up with an average number. So if you have that historical information, you are going to be able to calculate the average, right? But we don't. So let's say our average order value is let's say $40, right? $40. That's our average order value. All right, cool. Now, with businesses, there's always going to be refunds, right? People are always going to be, returning things. Maybe they don't like how it tastes. Sometimes you might have, a 30-day refund policy where they can bring it back, in 30 days, or tell you that they didn't like it. Maybe you promise that. That's like one of the things you have to do if you're just starting a business. You have to build that trust, right? If you don't have a refund policy, customers are gonna be like, I don't know if I want to. What if I don't like it, right? So you always want to have a refund policy. So from here on, we're gonna have percentages, right? Because we don't have actual data from the past, so we are gonna be using percentages, and this is gonna be the it's gonna be a percentage of the profit that we have, of the gross income that we have. Um, so all these things over here going down on, except for the taxes, this is gonna be a percentage of the revenue, right? So when I go to refunds here, I am projecting that, or assuming that uh, refunds are gonna be 3% of the revenue for the entire year, right? This is based on the this is an annual basis. This is on the annual basis, so I'm projecting them to be 3%, and I just kept it 3% to go all the way through, just to keep it simple. You can always adjust this later on. You see, as we go on with this. All right, so now we have discounts, right? Sometimes you have to, that's how you get customers. You have discounts: 40% discount, 30% discount, whatever, this much discount. So discounts are, so when it comes to refunds and discounts, these are going to be negative, right? Because you're taking away from your profit, right? These are negative numbers that are coming out of your pocket, right? If you do a refund, that means you're giving the money back to the customer. If you do a discount, that means you're collecting less than what you projected to be the average value, the average order, right? So these are the negative numbers here. So we're expecting to for 5% of the revenue to go to discounts, right? So that's money that we're throwing away. Now, moving on to the second part, which is the cost of goods sold. So first thing we have is going to be the product itself, right? We have to have the product made somewhere, right? I'm not going to be making the coffee or grinding the coffee or anything like that. We're going to have the product, maybe purchase it from a supplier. This is going to be the cost of the product. For this, I have it as 35% of the revenue. That's how much I think it's going to cost. It might go up over time. It might go down over time, but you can always change these numbers here. I just kept it the same for simplicity. Now, fulfillment, this is essentially, shipping and all this and that, labeling, all this and that. This is going to be 5%, right? It might be more, it might be less going on. You can always change these percentages later on. But for now, we're just going to keep it simple, keep it the same and uniform. Now, merchant services, this is going to be, since you are selling since it's an online business, people have to swipe their credit cards. You need payment processing, and it costs money. I think Shopify charges like, I think, 2%, 1%. So they're always going to charge you for those services. So we have merchant services here. Now moving on to the third part, which is operating expenses. That's how much it's going to cost you to operate the company, right? The business. The first thing is going to be personnel. So this is, if you hire maybe a freelancer to maintain the website, or if you pay yourself, or if you hire just like freelancers or 1099 employees, things to people. This goes under this, right? Think what it takes to run the company. So I'm projecting this to be 15%. And we also have marketing, right? If you're doing an online business, you need to market. Probably should have made it a lot more, but we're gonna keep it nice and smooth and keep it at 10%. And you also have other, so you want to leave room for anything that might happen, maybe something that you did not account for in your projection, right? You always want to leave a room for that. So for this one, we are leaving 5% of the revenue. We're gonna make sure that this is allocated to anything else that pops up. Now for the tax rate, this is a little tricky, but we're gonna be using. I'm gonna use this one right here. So this is. So this says that the SBA, the Small Business Administration, states that small businesses of all types pay an estimated average tax rate of 19.8. So I'm gonna be using 19.8%. That's pretty average for all small businesses. So I'm gonna do 19.8%. We don't want the. Oh, there you go. All right, cool. All right, so now we have our projections. I've described them to you. Pretty simple stuff here. All right, now I'm gonna go to the income statement. So this is where we have our template here that's already built. We just don't have the numbers on here, but it's pretty simple here. On the top we have. Let me go ahead and lock this up here. I'm gonna go to view. And I want to go to freeze top row. Yeah, that's good. All right. All right. So on the top, we have revenues, cost of goods, gross margin, and when we have operating expenses, and we go to our taxes down here. All right. And we end up with our net income. So there's one thing that's missing from here, right? That's usually on a lot of income statements. That's going to be depreciation. I don't have it on here because it requires another financial statement that I have not built on here, but we're gonna leave that on. We're gonna leave it off since we're operating an online business, right? We have our supplier, we have we have our fulfillment, we have all this and that, so we don't really have things that we can depreciate like that are of significance. Okay, so what I'm gonna do here so we're gonna start off with the revenue here. We're gonna start off in year one. So our revenue is going to be based on, we don't have any prior data from the past that we can use. So we're going to be using our assumptions to do this, right? So I'm going to do equal sign, go to our assumptions tab, and I'm going to multiply the customers, right? We want to have 1,000 customers. I'm going to multiply that by, multiply by the average order value. So that's the importance of knowing, the customers that you're targeting to get and the average order value. So if you've never sold anything, you can literally calculate this by calculating the average of the products on your website, and you can kind of like use that number. So when I multiply that by 40, there we go. So that means we're going to be making 40,000. So pretty simple. 1,000 times 40, that's 40,000. Okay. All right. Now for the next part, this is gonna be the refunds part. So how much are we gonna refund? So for this one, we'll do equal sign, and we'll do a negative amount. Actually, escape. So equal sign negative, because this is gonna be a negative number. This is taking away from our revenue. Okay. Now I am gonna select this right here, the 40,000 that we just made, and I'm gonna multiply this. Go back to assumptions by our projected refunds, right? 3% of the revenue, which is this multiplied by this. There you go. So we're expecting to refund 1,200. Okay. For the discounts, we're going to do the same thing, equal sign negative, and when I multiply the 40,000, go back to assumptions by the discounts, right? 5%. Actually, hold on. 40,000 multiplied by discount. Well, this needs to be a negative number actually. That's why you don't want to do this live. I'm gonna change this to dollars. Okay, there you go. It was in percentages. Let me make sure these are in dollars as well. Okay. Okay, cool. And when you're doing this, you can always check your stuff. You can always looking at discounts. $2,000. Okay, cool. Now you can drag this to copy the formulas. Let me go ahead and make this a little bigger. Double click. Okay, cool. All right, so now we have our revenue, we have our refunds and discounts. Now, so to get the net revenue, we're gonna take how much you made to begin with, or how much you were projected to make, and then we're gonna subtract the refunds and the discounts, right? Because we're not making that money; it's going back to the customer. So I'm gonna do you can do a simple sum formula here. Sum add this. Now we have $36,000 left, right, for the first year. Now I can just extend that formula over here. All right. So 36, 73, 110, 184. So this looks good, but you haven't accounted for everything yet. Okay. So a lot of people that start businesses, they think that, however much is in the account is how much is gonna, how much they project to make after refunds and discounts, or maybe just refunds, is their actual profit. But that is not your net income. That's where we're trying to get to, the net income. All right. Now we're gonna go to the product here. So for the product itself, this was, if we go back to the assumption, this was going to be 35% of our revenue. So I'm gonna go back to the product. All right. So we're gonna go ahead and select our net revenue, right? We're not using this anymore because this is an inflated number. When we have this, we haven't taken into account the refunds and discounts. So we're gonna be using the net revenue, right? Not the gross revenue. Net. And I'm going to lock this cell by pressing F4 twice. It's going to lock it. I'm going to go ahead and multiply by the product. Okay. Okay, cool. So this is 1200. All right. I'm going to go ahead and extend this. There we go. I don't like using a lot of shortcut formulas or shortcuts because, you don't really see what I'm doing. I've watched a lot of tutorials on YouTube where people are using a lot of shortcuts, keyboard shortcuts, where you don't know what they're doing. Where are you clicking? So I'm not going to be using a lot of those on here, but I might slip and use a few, but I'm going to try not to. All right, so this is how much the product is going to cost us each year, okay? Now, let's look into the fulfillment. For the fulfillment, that is going to be, shipping and packaging, all this and that. We're going to combine that into one. Okay, so this is going to be, grab this. The net revenue again, I'm going to press F4 twice. That's going to lock this cell so it doesn't shift when I move the formula. All right, so I'm going to go ahead and multiply that by our 5% that we have projected. And I'll do the same thing for merchant services, okay? Multiply that by our 2%. It would probably be more, honestly, more than 2%. I don't know what happened here. I would put it at like 3%, I'm pretty sure. If you're using Shopify, it might be more if you don't have the premium plan. All right, so I'm just gonna go ahead and extend the formula here. All right, so now we have our cost of goods, right? So sometimes you might have more. This is just relating it to this business here where we have, the only things you have to worry about is the product fulfillment and merchant services. Now, if you had more things, yeah, you definitely have to add on here, okay? Now for this same formula again, so COGS or COGS, this is the total cost of goods sold, right? We're gonna do a sum formula, just add these amounts here, right? Add these. Actually, I did a shortcut there. So you just do like sum, open parenthesis, you can select all of this and you can close it. There you go. That's how you do it. where he just, all right, cool. Now we have our cost of goods sold, right? Now look at this. We had 40,000 right here, and it's gonna cost us what, 15? Jesus. All right, cool. Now we're gonna go ahead and calculate the gross margin. So the gross margin is gonna be how profitable you are, right? Before, when you take into account the net revenue and the what is it, the cost of goods sold. So this is simple. So you do equal sign and you subtract your net revenue, right? That's how much you have after refunds and discounts, and you subtract the total cost of goods, right? Go. Now you have 21,000. You see that? Now your pockets are getting thinner because you thought you had 40,000 to begin with, right? You're like, oh, I gave refunds and discounts. Oh, now you have 36,000. And then you do all this. I only have 21,000. All right. That's the first year though. Um, sometimes it's perfectly fine to operate in the, in the negatives if you are, trying to gain a lot of customers, because this is assuming that we have 1,000 customers, right? And if you are trying to get as many customers as you can, you might have to lower your prices before you even get to that level. All right. So moving on to the third part here, which is going to be the personnel. So this is, freelancers. Maybe you have, maybe you hire, maybe you pay yourself as a 1099 employee, or something along those lines. Just anything that requires, HR type things. So this was projected to be, let's see here, what was it? I'm trying to figure out. So projected, or I need to look at my notes. All right. All right, let's do our personnel. Okay, cool. So we have our gross margin after this. All right, so let's go ahead and do equal sign, and we're gonna grab our gross margin. So this is what we have after, we take away. This is the difference between the net revenue and the total cost of goods, right? I'm gonna go ahead and I'm gonna lock this F4, click this twice, press that twice, and I'll multiply that by our projected, right? So I'm projecting to pay freelancers, maybe myself, maybe 15%. It could be more, it could be less, but for this, we're gonna rock with 15%. Okay, cool. All right, so now we are. I'll move this over here. Okay, cool. Marketing, like I said before, if you're running an online business, marketing is gonna be your best friends. Your best friend. You need good marketing. Okay, F4 multiply by marketing, and then we also have other. So this was, I believe, 5% or something like that. Okay, so F4 twice. No, multiply that by our thing was the other. Yeah, 5%. All right, there you go. I'm gonna go ahead and just drag the formula to the right. And same thing over here. We're gonna go ahead and hit or do the sum formula, or you can use the keyboard shortcut, which is Alt plus and equal sign, right? That does it for you. You just drag the formula here. All right, there you go. Cool. All right, so now we've built our essentially revenues and expenses. That's what we've done here. Actually, if you want to do a percentage of, a lot of people like to have, what is the percentage of my gross margin? So for this, you could just do the 21. You could do equal sign the 21,000 divided by the net revenue here. That should give you a percentage, okay? And you can change this to percentage if it's not already in percentages. Cool. All right, so once you've done all this, our next part is gonna be the operating income. So that's gonna be how much we So this is going to be the difference between the gross margin, which we got by subtracting the cost of goods sold from the net revenue, right? That is our gross margin, right? How much we're actually making after removing the cost of goods. Now, for operating income, we need to actually get. We're gonna be getting the do equal sign. We're gonna get the gross margin, which is 21,000, and we're gonna subtract the total operating expense, okay? Because we have not taken this out of how much we are looking at as profit at this point, right? So now we're taking out the personnel, marketing, and other. Take that out. Now we only have 14,000 left, okay? I'm gonna drag this formula all the way here. Make sure it's good. All right, cool. Now for the interest, right? This is gonna, if you have any loans, any things like that. We don't have anything like that here. So for this example, I'm gonna go ahead and put 0% when it comes to this. We're not gonna mess with any interest here, okay? So we're not gonna be messing with it. So we don't have any interest. So now if you had interest, right, you'd have to take that out, right? So it'll be equal sign. You would take the operating income and you would subtract the interest if you had any interest, right? You get that from the balance sheet, I believe. If I'm not mistaken, I think that's where you get it. So if you had like $20,000 in interest, then you'd be in a negative, right? That you have to pay. But we're assuming that we don't have any interest on here. Okay. All right. Cool. Now this is our. Let me just make this bold. Now this is gonna be our how much we have after we pay off our interest. That's before taxes, right? We haven't taken taxes into account. So there's a lot of things you got to do here. So a lot of people don't take into account maybe if they get a loan to start their business, right? You have to pay interest on it. Maybe you might not be actively paying it, but it's getting charged, right? So that's how you end up paying a lot more, right? Simple finance. You also they don't take account when it comes to taxes, right? The end of the year comes, they didn't file their quarterly taxes. I'm gonna wait until the year ends, and then boom, now you owe more than you have left, right? So you want to try to project these things. That's the importance of projecting these income statements. All right. All right. So for the taxes, we said we're gonna be using 19.8%, right? This is based on, we said it's a small business, so it's based on the SBA, right, which is the Small Business Administration, and they say the average is 19.8. They said for sole proprietorship it's like 13.3, and then 23, and then 26 for S corp. But for this, we're using the average 19.8. Go back to my video here. Oh, there you go. All right, so for taxes, we are gonna do equal sign. We're gonna take our net income, that's the NI here, before taxes, right? And we're gonna multiply this by our tax rate, which is 19.8%. Okay. So much we owe. All right, there you go. See, the more you make, the more you owe, right? So this might, be, if we're being realistic, sometimes you might find, loopholes. If you get a good accountant, you might be able to pay less. But it's good to be realistic, this so you know what to expect. If you need to find an accountant, it's going to help you lower that amount. All right, so finally we have the net income here. So the net income is going to be the amount that we had before taxes, right? And then we subtract the actual taxes because we'll pay them off, right? Pay the taxes off. Now we have 11,000. Let's go all the way through here. Boom. There we go. So now this is our income statement forecast. This is misspelled. Income statement forecast that is projecting 5 years. Like I said before, these assumptions, the beauty of this is dynamic. You can tweak the assumptions here, right? So let's say let's do something crazy. Let's say here we get 10,000 customers. If I go here, you're gonna see that these numbers adjust. I have $400,000 now. They all adjust. So that's how dynamic this is. that's the reason I call it a template, because you can always change these assumptions, right? When they become reality, you can always, change this to, more years here, and you can actually replace this with the actuals, right? A lot of people like to replace, they have projections and they'll add an actuals column where they have the actual numbers when as they happen, right? The year is over, they compare their projections or their forecast to the actuals, right? And then they look at the difference. It kind of like helps you analyze, if you're a financial analyst that's doing something like this, it helps you analyze the trends or how accurate your model is, right? Or your template is. So these you can always adjust, right? Let's say after the first like 3 years, or the first 5 years, we realize that, you calculate the average. Oh, we're actually selling more than we thought we were. It's actually $60, on average, right? So you can really just adjust this. Oh shit. You can really just adjust all this, and you see that the numbers will change as well, right? So that's why this is dynamic, right? You don't have to mess with this part here because it's already done for you, unless you wanted to add, if you have new cost of goods, like, that are can affect this formula here, you can, tweak this. Or if you want to add more things, like if you get a loan, if you get a small, what is it, a PPP loan, right? And there's interest on it. I think those are interest free. They don't have any interest. You can add that interest percentage here. You can add it to your assumptions actually, and you can just multiply. It's always going to be a percentage of the revenue, because that's the driver in everything, right? So if it's a subscriber based business, you might want to take into account how many you assume you're gonna lose, or you project on losing, right? Because if someone subscribes to a service, some people usually cancel. If you have a free trial, after the free trial, they'll cancel, or maybe just don't like it, so they're gonna cancel. So that's something you might need to include on here as a negative amount, right? Because it's gonna be not a negative amount, but like it's good to keep track of that number. And there's really no way of knowing this until you've actually operated the business, and you have kind of like average, you have data to kind of like to build your assumptions on. But it's hard to, maybe people love it so much you have zero unsubscribers, right? So yeah, so that's really the main. So I tried to use, things that weren't too specialized, things that were more general, right? That you can always add more things on here. Yeah, so this is the template here. I have a link in the description below if you want to get the template. If you want to get that, it's not free. It took me hours to make, and it's definitely gonna save you time to make. That's the beauty of this, because you can't really, you don't have to mess with all of this, right? Unless you're adding more years. Yeah, let's say you want to add more years. Let's say you've been operating for 5 years, you figure out some good numbers, but you want to continue this as a business. You can always continue with this, right? The more data you have, that's actual, right? A lot of people separate the actuals from the projections, or the forecasted numbers, right? The more data you have that's actuals, you can replace this with the actual numbers. Now you can base your future projections based on actual numbers, right? Yeah, so you don't really have to mess with all of this, and you can probably get rid of the assumptions over time when you have actual numbers. All right, so let's bring me back here, see if anybody has any questions. Be able to go over those real quick before I log off. Um, do you do this as a financial analyst? Yes, definitely. I actually used to do this back in when I was back in college. Was it sophomore year? It was the summer of my junior year, actually, before I went to senior year. I actually worked or interned as a financial analyst at a huge company, publicly traded company. Um, that's an insurance company. It does like marine. It does all types of insurance, like in every state. It's in a bunch of countries. It's a global insurance company. So I was under the VP of finance, and this is literally what I had to do. I was looking at, I believe one of my first projects was essentially comparing the forecasted amounts or the projected amounts or forecasted amounts with the actuals, and then trying to come up with new, you know, kind of like correcting, you know, the projections, like the new projection amounts. Yeah, that was my first project. It was on a net income. And if you ever work for an insurance company, the terminology is gonna be different, right? It's gonna be really, really, really different when it comes to if you're working for an insurance company. Let's see here. Says, is this intro to finance material or is it more advanced? This is actually intro. So this is essentially based on, if you've seen some of my old videos, I always say that accounting is the foundation of finance, right? This is like basic accounting, really. But in accounting, you use the actual numbers. You're not projecting anything. You're not gonna project like nothing really. You're not projecting anything when it comes to accounting. You're using historical data in order to, make financial statements. But when you move that to finance, you're gonna be projecting. You look more towards the future. Accounting looks in the past, right? You're using old data. You have to dig into like databases, get all this data, make it work, right? Now, when you go into finance, it's more like a gray area where you're looking into the future. That's why we can get away with using, things like assumptions, right? We can assume that, we're gonna get 1,000 customers, and the average is gonna be. But over time, we get to make that data more accurate. So if you are making projections for a business that has never really existed before, or a business that does not have any data from the past, you have to be really conservative, right? You cannot say you're gonna, like what I did here. I used 1,000 customers, right? I'm gonna get 1,000 customers people subscribe to my service within the first year. I mean, that might be a little, overreaching, right? You might want to lower that down to maybe 100, right? It's always good to be under than over, because if you're over, you're gonna expect money that you're not gonna get. You probably be more disappointed, right? And it will probably mess up all your projections. So it's always good to be really conservative. But back to the question, this is intro to finance, right? When you go into finance or accounting, first thing you're gonna learn is the financial statements, right? This is just one of them. Income statement. You have the balance sheet. You have the statement of cash flows. You have there's quite a few financial statements that you're gonna learn, but the income statement, if you're gonna go into finance, we love the income statement. This is what we can project, right? This is what a lot of if you're a financial analyst that's doing this for small businesses, this is what they want to see. They want to know, how much am I gonna make? Am I gonna be at a loss? Am I gonna be make a profit? How much am I gonna owe in taxes? How much are my expenses? Right? You might end up breaking this off into expense projection, right? You might go into detail if they know exactly what they need for their business. You might end up, projecting, doing an expense report. A couple of years ago, I worked as a accounting. I forget the role. It was accounting coordinator. So it was essentially like a mixture of accounting and finance. And one of the things I had to do was do expense projections. The good thing is the company had a lot of data from the past. A lot of data that they like receipts that a lot of the employees had submitted. So I was just using that to come up with the averages and project that. But yeah, so this is pretty much basic finance, but then the projecting part is or the forecast part is pretty simple as well. It's a mixture of both, basic and advanced. You might lean more towards advanced as you're projecting, but if you look at this, it's pretty simple because it gets a little hard when we're using actual numbers, right? When you have to use data from 5 years ago to make a projection for the next 5 years. But if you're using assumptions, it's pretty simple because we assume that everything else is going to be a percentage of the revenue. Um, let's see here. We have J. Cole. I think I went to high school, J. Cole. He knows my real name. If you guys want to look me up on LinkedIn, you probably find me. I never put my real name or my LinkedIn links. Glad to you successful, Satan. Nice hearing you from you, man. DM me on Instagram. Let's connect. Says I'm in my intro class in finance at UTSA. Also, I went to UTSA. Good to see someone from UTSA here making things of value for others. Oh yeah, definitely, definitely. Yeah, I went to UTSA too. I was an accounting major for like two years. I thought I wanted to go into accounting, but then I interned in accounting. But then I was like, I showed the people that were working in the, it was with the city, actually, the city of San Antonio. um, so they counsel with older people, really bored doing the same thing every day. I love accounting, but it was just like, I don't want to do this, man. I don't want to do this all day. I don't want to do this for like a couple of years. I don't want to do this at all. But it's still cool. So I switched over to finance. And yeah, I just been in finance ever since. And I graduated from UTSA. Went to work for an insurance company actually here in San Antonio. I was there for like 2 years. I got promoted pretty quick. I was in management within 2 years. I was probably the youngest person there. And then recently, a couple months ago, I went into the big four consulting firms. Now I do consulting, risk management, which was one of the classes at UTSA actually. So if you go to UTSA, I recommend that take a Professor Sweet, great professor, and take his risk management class. That class is going to help you a lot in finance. Not the material itself, but how to manage risk, right? Because he talks a lot about banks, but you can apply that to anything really. If you are working as a financial analyst and you have to manage. A lot of financial analysts don't really manage risk. They just do what they're told. But then when you take it a step further and be like, well, we got to mitigate this before we even come up with the analyze this, or this analysis says this, but then wouldn't this risk the business doing this? Like just knowing those things will probably put you like 100 steps ahead of like your peers or whoever you're working with or other analysts. But yeah, so that's pretty much it. Just wanted to build that. I'll probably upload just the without the commentary the video on the YouTube channel. Yeah, but I'm glad to meet more people from UTSA. Majoring in finance. Keep at it. It's a good field to get into. There's a lot of money in the field to go around. Everyone will get some. Anyways, the template. There's a link in the description below for the template itself. If you guys want to get that. It is not free because it took me a couple hours to make or to figure out. Not a couple hours, but maybe an hour or so. But it's not free. A lot of people say like it's free, go get it, and then boom, you got to pay money to get it. Yeah, it's not free. Or you can just follow this and you know how to make this. Pretty simple. It's a pretty simple template. Uh, Anyways, thank you so much for watching. I'll catch you guys on the next video, which is probably gonna be on I don't know, maybe tomorrow or maybe the day after tomorrow. I don't know. But I'll catch you guys on